Hello, everyone. We're going to start our financial accounting course with reviewing Chapter 1, the financial statements. First thing that you see up on your screen is Walt Disney Company. This is what we would refer to as this income statement, or the way it's labeled here is consolidated statements of income. Income statement, consolidated statements of income, statements of income. Those are really all different ways of saying the same thing. When we're talking about a company that's generating revenues and then has corresponding expenses, we want to know whether or not the company is actually making money, if it's profitable or not. This statement tells us whether or not it's profitable or not. So for 2016, as an example, you'll see that net income appears to be $9,391. But you could see on row 3, it says adapted in millions. So you would add six zeros to the end of it. So this is really 9,391,000,000. And then in 2015, they made 8,382,000,000. So you have your service revenues, which is the income that came in, total revenues listed here, and then all of your expenses listed to give you your net income. There are 5 learning objectives we will review in Chapter 1. The first learning objective is to explain why accounting is critical to business. Number 2, we're going to explain and apply underlying accounting concepts and assumptions and principles. Number 3, we're going to apply the accounting equation to business organizations. Number 4, we're going to construct financial statements and analyze the relationship among them. And then number 5, we're going to evaluate business decisions ethically. So learning objective number 1, explain why accounting is critical to business. Accounting is an information system that measures business activity. When we say measures business activity, we talk about the financial statements. We talk about the income statement, which shows whether or not the company was profitable for that period of time. That's what we mean by measuring business activities. Accounting information systems also process data into financial statements and reports, and then it communicates results to decision makers. In the end, accounting is about creating information that is then going to be distributed to interested users. These interested users are going to take that information and make decisions based upon that information they're provided. So the flow of accounting information, how that information flows through the system, the accounting information system, you first start with people making a decision of some sort. So as an example here, you can decide to open up a plant in Visalia, and that decision's made. You go out and you start executing that decision. You open up the plant in Visalia. Then once you start executing that plan, you're going to create business transactions. Business transactions are really the recording of economic events. When an economic event has occurred, you have a business transaction. Something has happened. And then from there, we move to taking those transactions, recording them into the system, and then putting them in a way that we could generate reports. So we make decisions, transactions occur, and then we can summarize those transactions to create financial statements. And then it starts again. People making decisions now use the new information that's generated based upon the past, what has happened in the past. The question becomes, who uses accounting information? Well, certainly individuals do. Individuals will do that if they're looking to invest in a company. They want to know whether or not that company is solvent. You don't want a company that you're going to invest in. You don't want that company to go bankrupt in less than 2 or 3 weeks or even a month or even a year. You want them to be around for a significant period of time. Investors and creditors. Well, I already mentioned to you individuals as investors, but then you have creditors. Those are entities that are looking at loaning money to others. So banks would obviously be interested in financial statements. Even as an investor, and we're going to learn about that later, you can invest in what is referred to as bonds or commercial bonds, which then makes you, rather than a shareholder, you become a creditor. We'll learn much more about that later. Regulatory bodies, certainly the most obvious ones are the Internal Revenue Service for the federal government, the Franchise Tax Board representing the equivalent of the Internal Revenue Service, but for the state of California. And there's the Secretary of State. There are local entities like counties, cities. So there are many regulatory bodies that may be interested in financial information. And then nonprofit organizations are also identified here as a user of accounting information, but they also generate their own accounting information. Now, this is, for most of you, this is your first accounting course, but what you're going to learn is that there's really two types of accounting. Actually, there's three, but there are two main types. There is financial accounting. Financial accounting is what you're going to be learning in this class. And what we have to remember, financial accounting is focused on external users. In other words, these are people that are going to be making decisions that are really outside of the organization. That does not mean that managers are not interested in the information, because certainly they know that external parties are going to be making decisions based upon that information that's generated. So they're going to have a lot of interest in it, but the objective for financial accounting is to create information for investors, creditors, government agencies, and the general public. Managerial accounting, on the other hand, which is accounting 2, that's going to be the next course you take after you finish this course, potentially if you want to take that second course, or if you're required to as part of being a business major. Managerial accounting is for managers inside the entities. So when we're talking about managerial accounting, you're talking about information that's definitely for management. And so some examples are going to be like budgets, forecasts, projections. And when you look at these three items that are listed, you can almost immediately see the difference. Budgets, forecasts, and projections are all about the future. That's managerial accounting. Financial accounting, what we're learning in this class, is really about historical information. It's about taking what has already occurred in the past and presenting it in a way that people can make decisions. So financial accounting is the past, managerial accounting is the present and future. Now, when one decides to open up a business, there are different options for them in terms of a business entity or a form of business. And there are 4 different entities listed on this slide. We can see the differences between those different entities. The first criteria we're going to look at is owners or ownership. How does that work? Well, for the first type of entity, we have the proprietorship. Often we refer to this as a sole proprietorship. Sole proprietorship means one individual. When you have a partnership, that's the next type of entity or next form of business. A partnership is made up of 2 or more owners. So by default, if you have more than one owner, then at minimum, you're going to be a partnership. You can have what are called LLCs, limited liability companies. And a limited liability company is similar to a partnership in the context that in most cases, you're going to have more than one individual owning the business. In most cases. You don't have to, but in most cases you are. The LLC is referred to as a limited liability company. And the only difference between the partnership and the LLC for entity purposes is that the LLC enjoys what we're going to learn more about, just a bit about limited liability. The members are protected to some degree if there are mistakes or problems with the business. So you get the limited liability company, that's the limited liability reference. Corporations, they've been around for a long period of time. Those are definitely individuals who own the company, but they own shares of stock, and they are referred to as stockholders. And then the corporation will also allow the shareholders to enjoy limited liability. So number two, the second thing we're going to look at is personal liability. Well, we've already kind of mentioned a little bit about it, but we'll review it again. So when you're a proprietorship, you are personally liable for everything that occurs with that business. As an example, if you own a restaurant and somebody comes in and slips and falls in your restaurant, the question is, do they sue the business or do they sue you and as the owner? And the answer is, there is no distinction. When you're a sole proprietorship, you are the business. So, they may list the business name, but your name is going to be there as well, and you're going to be sued. You are the business. When you have a general partnership, you have the same situation where the business will be sued, but the business is made up of partners, and all the partners are personally liable as well. So you're taking the sole proprietorship concept of liability and you're really just spreading it across more individuals. You can have what's called an LLP, a limited liability partnership. And when you have a limited liability partnership, then you can identify specific partners who are considered to have limited liability. You can do that. But even if you do have that, there's always going to be at least a minimum of one general partner that will be completely liable. When we move into a more complete limited liability, we're talking about an LLC. A limited liability then allows for members to not be personally liable. The example I would give you now is that if you own a restaurant and you have an LLC and you have a number of members, chances are that if somebody falls and slips and falls in your restaurant, they will sue the LLC and the members are not personally liable for it. The LLC is definitely going to give you much more protection than the sole proprietorship and the partnership. And then finally, it's the corporation, and the same instance or the same situation as what you had with the LLC. The stockholders are not personally liable. When we talk about corporations, it's kind of easier to see your limited liability because if, for example, I own shares through my investment accounts of different companies, but Disney, Walmart, Microsoft, Apple. So if somebody makes a mistake or somebody slips and falls at Disneyland, well, they can't sue me personally. So that makes it pretty easy because it's a pretty large organization. We create that veil, that protection for the investors. All right, so talking a little bit more about each one of these entities, the proprietorship is a single owner. We talked about that. They tend to be smaller retail stores or solo providers of professional services. So when I started my practice back in 2005, I was a sole proprietorship, and only recently did I convert it to a corporation. What that means now is that the proprietor is personally liable for all the business debts. Now, even though the proprietor, from a legal perspective, there's no distinction between the owner and the business. They're really just one from a legal perspective. From an accounting perspective, we do separate the two. The business is its own accounting entity, so we account for all its revenues and expenses and its assets, liabilities, and equities independent of the owners so that we really understand exactly how the business is doing. The partnership, two or more parties, income flows through to the partners. So if the partnership makes money, the partnership technically doesn't really even make any money. If you're in partnership with one other individual and the partnership earns 100,000 and you own 60% and the other individual owns 40%, then you take $60,000 as income for you personally, and the other owner takes $40,000 personally for that income. So that income is split between the two partners. And we refer to the partnership as a flow-through entity, a pass-through entity, because it doesn't really generate income for itself. It generates income for the partners. When we have partnerships, they're usually smaller or they can be medium-sized companies. You do have general partnerships, have mutual agency and unlimited liability. That's what I mentioned to you earlier. General partnerships or partnerships in general just don't have any limit in terms of liability. They can't, which is kind of scary too, because if you are a partner within an organization and another partner makes a big error and causes the partnership to be sued and the partnership loses, then even though it was that other partner's error, you're still getting, you're still liable because of the business, but then even personally, they can still go to your personal assets. So you got to be real careful with the partnerships. You can have what I refer to as a limited liability partnership, which means that you can identify specific partners that are limited in terms of their liability. But even when you do that, you're going to have at least one general partner who has unlimited liability, so that they're personal assets. Now you might wonder, well, who would possibly do that? Limit the liability of other partners and then take on all that liability. Well, first of all, your first layer of protection is a good insurance policy, so you want to make sure you have pretty good insurance. The second thing that might happen, and this happens a lot with professional services, is that if you have a very good, productive employee who's doing really well and is generating a lot of business for you, like a CPA firm, and you've got this new CPA, or the CPA that's working is generating a lot of business, he or she's generating a lot of business for you. And all of a sudden you start thinking, well, God, I might lose that employee. And that employee hasn't shown a lot of interest in being an owner of the business, but yet you're afraid that maybe some other business is going to take them away and they're going to end up working for somebody else, as an example. So you want to find a way to get that employee to be more committed and stay with your organization. By doing that, you would then offer ownership. Now, the employee would say, well, why would I do that? Why would I want to become owner and then have all this kind of liability? Well, you say, okay, you can be a limited partner. You're going to have a limited amount of percentage of ownership. But, because you're so small in size in terms of your ownership, we're going to go ahead and limit your liabilities. So you identify specific partners. You create what's referred to as a limited liability partnership. And then you identify the specific partners that you want to be limited liability partners. An LLC now has the limited liability, and that means the business is responsible for debts, not the owners. You can have a single member limited liability company, but in most cases they're going to be more than one, and all of the owners are referred to as members. Members do enjoy limited liability, and this is again like a partnership. There's a flow through between the two entities. The benefit or the good thing about a limited liability company is that you limit the liability associated with the owners and the ownership. Corporation is owned by stockholders. They are not sole proprietors. They're not partners. They are not members. They are referred to as shareholders or stockholders. And corporations usually are able to raise larger sums of capital, and they do that by issuing stock. When they sell stock, a stock really represents the owner, a piece of paper that says you own this company. And then individuals like you someday will buy shares, and then you become part owner. They are formed under state laws, so if you ever want to form a corporation in the state of California, you register with the California Secretary of State. They are legally distinct from its owners, so there's a legal separation between the entity and the owners. And so that's what also creates the limited liability, because now if somebody sues the corporation, generally speaking, the shareholders are going to be protected. So the last bullet point says stockholders have no personal obligation for the corporation's debt, and they enjoy limited liability. Now that's true as well when there are a lot of organizations that start off as sole proprietorship and convert over to corporations. Now when that does happen, I just want to give you a heads up. Banks are not likely going to loan the corporation money, particularly if it's only been around for a limited amount of time. So the owners, in many cases, do have to then sign and guarantee those notes as well. One of the disadvantages to the corporation is what is referred to as double taxation. And that means a corporation pays income tax, and then the shareholders pay income tax as well. I can show you how that works. Okay, so let's assume that the corporation earns $100,000 net income. Now this corporation has to file a tax return. And when it files a tax return, there's going to be a tax on that $100,000. So we're going to say the corporate income tax. And let's say that the corporate income tax is 25%. We'll take the 100,000 and we'll multiply that by 0.25. So corporate income after taxes, well, after you pay those taxes, you're going to be left with $75,000. Now, let's assume in this case, this doesn't have to be the case, but let's assume it just so that you have a clear picture of what we're talking about when we say double taxation. Let's say that the corporation decides, well, we have $75,000 left over for the year. We're going to pay dividends to shareholders. And how much are they going to pay? They're going to pay it all out. So now $75,000 is paid out to the shareholders. And so that then what we're going to learn about is what's referred to as retained earnings. That's how much the corporation makes, the corporate income, and retains for its business. Well, it didn't retain any income here. It turned around and gave all the owners the money. So $0 were retained. The double taxation occurs because this taxable to the shareholders. So because the corporation paid $75,000 to the shareholders, at the end of the year, the corporation is going to send what's referred to as a 1099 dividend or 1099 div, which is going to be a report that shows if there's just one shareholder, that one shareholder receives $75,000. Well, guess what? That shareholder is going to have to add that $75,000 to their personal tax return. And they're going to have to pay taxes on it. So when they say double taxation, we say one, it's going to be taxed at the corporate level, and then it's going to be taxed again to the shareholders, because they're going to have to report the distribution to the shareholders, the dividend distribution to the shareholders. They're going to have to report that on their personal tax returns. Thus, the disadvantage to corporations is that you have what's referred to as double taxations. Now, we don't know what percent, every individual, every shareholder is going to be different in terms of their personal, how much of this is going to be taxable to them. We don't know, it just depends. I mean, every individual has different circumstances. They may be making a ton of money in different other places and have a very high tax rate, or maybe they're losing money everywhere else and they don't even pay much in taxes on this because they're losing all kinds of money. So you don't really know for sure how much, but you do know for sure that that income potentially is subject to double taxation, once at the corporate level and once at the shareholder level. Okay, and then the stockholders who purchase shares, those are the shareholders, the stockholders, they elect the board of directors. They typically have elections annually, and so the stockholders are forwarded ballots, and they complete those ballots and submit them in so that they're voting for the board of directors. Now, those that are elected by the stockholders to be the board of directors, those individuals, they could be a pretty small board, maybe made up of 10 individuals. They really set the policies and they appoint officers. They don't run the day-to-day operations of the company or the corporation, but they do appoint officers who do run the business. So the shareholders will identify the board. That would be, as an example, the president, the vice president, the secretary, the treasurer. Those are the board members. And then those board members will then appoint the officers, including the CEO, the chief executive officer, CFO, chief financial officer, COO, chief operating officer. It will identify or appoint all, in essence, hire them. The board will hire those officers, and then those officers will run the business.